Welcome to the deep dive. Today, we're zeroing in on a pretty critical piece of the VA Home Loan Guarantee Program.
We're talking about sanctions.
Exactly. The sanctions the VA can actually levy against program participants.
Right.
So we're going to break down what these sanctions look like, who these program participants actually are, and really why these rules even exist.
It's all about understanding the framework, the safeguards.
Yeah, the safeguards designed to protect veterans during the home buying process and, keep the VA program's integrity intact.
Absolutely. It really boils down to accountability.
We'll be hitting on things like civil money penalties, program exclusion. Those are the main types.
And importantly, their appeal rights. People facing these things aren't just left hanging.
Good point. So let's start with that term, program participant. Who exactly falls into that bucket?
Right. It's pretty broad, actually. More inclusive than you might first guess.
Okay, let's unpack this. The VA definition says basically any person or entity doing business related to the VA loan program.
Any person or entity. That's key. So it's a wide net.
So obviously lenders.
Lenders, yes. And importantly, people employed by lenders too.
Oh, okay.
Then you've got loan holders, loan servicers, the ones managing the loan after it's made.
Makes sense.
But it keeps going. Builders are in there.
Builders, okay.
Real estate brokers, agents, even management brokers who handle properties. They're all participants.
Wow. Okay. And repair contractors.
Yep. Repair contractors on VA properties, compliance inspectors checking on regulations, fee appraisers setting value.
Fee appraisers too.
Salespersons, and then the whole manufactured housing side. Manufacturers, dealers, park operators.
So it's a really long list.
It is. But here's a super important distinction.
Okay.
The veteran. The veteran who is actually getting the VA loan. They are not considered a program participant in this sense.
That's huge. So this isn't about penalizing the veteran borrower.
Exactly. It's about the conduct of the people facilitating the loan, ensuring they're playing by the rules.
Right. So what if someone wears both hats? Like they're a real estate agent, so a participant, but they're also a veteran using their own VA loan.
Good question. If they face sanctions as, say, an agent for professional misconduct, that doesn't stop them from using their own VA loan entitlement as a veteran for their own home. The roles are separate in that regard.
Okay, that clears that up. So now we know who we're talking about. Let's get into the types of exclusion. You mentioned full and partial.
That's right, full and partial exclusion. And the difference is pretty much what it sounds like, but the scope is important.
Okay, so full exclusion means?
Full exclusion means you are completely out, barred from all VA loan guarantee business. Directly, indirectly, doesn't matter.
No way back in, essentially, for that business.
Within the VA loan program, right. You can't do it yourself. You can't get someone else to do it for you.
And partial?
Partial is, partial. It involves specific limits. Maybe you can't do a certain role within the VA loan process, or there are restrictions on how you conduct business.
Gotcha. Now, this next part sounds really important for people in the industry.
It is. Program participants, like lenders or brokers, have a responsibility here.
Which is?
They are prohibited from doing VA business with someone who's been excluded if the transaction itself is covered by that exclusion.
Okay.
And they also can't have an employee who's excluded performing duties they're barred from doing.
And if they mess that up, if they work with an excluded party,
they themselves could face VA sanctions. So there's a real onus on them to check.
Which leads to the obvious question. How do they check? How do you know who's excluded?
Okay, so the primary tool is managed by the U.S. General Services Administration, the GSA.
GSA.
They maintain the list of parties excluded from federal procurement and non-procurement programs.
That's a mouthful.
It is, but you can get it in hard copy through subscription, or, much easier, access it online.
So industry folks can just look people up?
Pretty much. And the VA provides GSA contact info if you need more details about someone on the list.
Now, does this list cover everything? Is it just VA exclusions?
Good question. Some exclusions on the GSA list are government-wide. That means across all federal agencies, including VA.
Okay.
Others might be specific just to one agency or even one program within an agency.
How can you tell the difference?
The GSA list uses something called cause and treatment codes.
Codes?
Yeah, they give you a clue about why someone was excluded and the scope. The list itself and the GSA website explain these codes.
And if you need more detail, like confirming identity or the exact sanction?
The advice is to contact the agency that actually imposed the exclusion in the first place.
What about VA-specific exclusions?
Right. If the code on the GSA list is VA, meaning the VA issued the exclusion, you should contact the local VA office that has jurisdiction over where that excluded party is based.
Okay, but here's something you mentioned. Some VA sanctioned parties might not be on the GSA list.
That's a critical point. Yes. Not everyone sanctioned by VA, especially with certain types of sanctions we'll discuss, makes it onto that GSA list.
So just checking the GSA list isn't always enough.
It might not be. If you have any doubt whatsoever, the safest bet is always to check with your local VA Regional Loan Center or relevant office.
Okay, that really highlights the need for due diligence, doesn't it?
Absolutely. Lenders, brokers, builders, anyone participating should really make it standard practice to check before they hire someone for a VA-related role or do a VA deal with another participant.
But not obviously if it's just a veteran using their own loan benefit.
Correct. That's the key exception we keep mentioning. This is about the professionals involved in the process.
Give me an example. When would this checking be crucial?
Okay, say a lender wants to hire a new underwriter, specifically for VA loans. They absolutely should check if that underwriter is excluded.
Right.
Or a lender is working with a builder on a new subdivision. Maybe they hear rumors the builder had issues with HUD or FHA in the past.
Checking the GSA list and maybe the local VA office would be smart.
Exactly. Even a management broker picking contractors to fix up VA-owned properties, they need to ensure those contractors aren't excluded.
Makes total sense. Okay, let's shift gears a bit. False lender certification. This sounds specific to lenders.
It is. This is a big responsibility for lenders.
So what's required?
With every single loan they submit to the VA for guarantee, the lender has to include a signed certification.
Just signing a form.
It's more than that. It's a formal statement. They're attesting that they followed all the VA's rules, regulations, and relevant laws when they processed and underwrote that specific loan.
And the VA dictates the wording.
Yes, they specify the exact language that has to be in that certification.
Okay. What happens if a lender knowingly fudges that, makes a false certification?
The consequences can be pretty serious. The VA can hit them with civil money penalties.
How much are we talking?
It can be substantial. It's the greater of 2 times whatever the government lost on that loan, or up to $10,000 per violation. So it adds up.
Ouch. Is it just money?
Not necessarily. False certification can also lead to other sanctions, like debarment or suspension from the program entirely.
Which we'll get to later.
Right. And it can also mean losing their automatic loan processing authority.
Okay, now here's a tricky point you mentioned earlier. If a lender only gets a civil money penalty for false certification,
yes,
do they end up on that GSA excluded list?
Generally, no. If the only sanction is the monetary penalty for false certification, they don't automatically go on the GSA list.
So other participants could still potentially do VA business with them?
Potentially, yes, unless another sanction, like debarment or suspension, was also imposed alongside the penalty. Then they would be on the list.
That's a really important distinction.
It is. It affects how other participants interact with them.
Okay, let's talk about that automatic authority withdrawal you mentioned.
Right. This is another tool the VA has specifically for lenders.
What is automatic authority quickly?
It allows lenders to process VA loans more efficiently without sending every single file to the VA for prior approval before closing. It's based on trust and performance.
Got it. So the VA can take that away?
They can. If there's what they call proper cause, they can withdraw a lender's automatic authority. They have to give 30 days notice, typically.
And this applies to all types of lenders, supervised, non-supervised?
Yes, both. Supervised lenders, like banks regulated by federal agencies, and non-supervised lenders, like many mortgage companies.
So if your automatic authority is withdrawn, can you still do VA loans?
Yes, you can. But you lose the automatic part. You have to submit every loan on a prior approval basis.
Meaning the VA reviews and approves each loan file before closing?
Exactly. It shifts the burden back to the VA for individual approval, which obviously slows things down for the lender. It's a form of increased oversight.
And like the monetary penalty situation, if a lender only has their automatic authority withdrawn,
they also do not automatically appear on the GSA excluded list, again, unless other sanctions like debarment are also in play.
So others might still engage with them in other VA capacities.
Correct.
Can this withdrawal be permanent?
It can be indefinite, yes.
Under what circumstances?
Well, if a lender stops meeting the basic qualifying criteria to even have automatic authority in the first place.
Like what?
For a supervised lender, maybe they lose their regulated status. For a non-supervised lender, it could be losing their approved underwriter, not maintaining enough working capital, or failing to submit required financial statements. kind of the CISIC requirements to operate responsibly.
Okay. Any other reasons for indefinite withdrawal?
Yes. Any of the causes that could lead to full debarment can also trigger indefinite withdrawal of automatic authority.
Which we'll detail later.
Right. And one more. For new non-supervised lenders still in their initial probation period, if they show really poor underwriting or are consistently careless in processing loans, that can also lead to indefinite withdrawal.
So besides indefinite, there are shorter withdrawals?
Yes, fixed periods.
Mm-hmm.
The VA mentioned 60 days, 180 days, and even 1 to 3 years.
What triggers a, say, 60-day withdrawal?
This is often for things like repeated documented deficiencies in credit underwriting, maybe consistently using unstable income to qualify borrowers, or ignoring significant bad credit.
Kind of sloppy work.
Sort of. Or improperly handling verifications like letting borrowers hand carry their own employment or deposit forms, which is a definite no-no. Or just consistently submitting incomplete loan packages to the VA, things that show a pattern of not following procedures carefully.
Okay, what bumps it up to 180 days?
Now you're looking at potentially more serious issues. Submitting loans that clearly conflict with VA credit standards, showing imprudent lending that puts the government at risk.
Riskier loans, basically.
Yes. Or failing to disclose important negative information about the borrower's ability to repay. Mishandling verifications in a way that actually leads to misinformation being sent to the VA.
Okay, that's worse than just sloppy.
Definitely. Also, substantiated complaints, where a lender misrepresented VA requirements to a veteran, say, about interest rates or allowable fees, or improperly charging fees on the closing docs, and then refusing to refund them when the VA points it out, even deliberately delaying loan closings without good reason.
These sound like more significant conduct issues.
They are. And then you get to the 1 to 3 year withdrawals.
What lands a lender there?
This is for really serious stuff. Things like failing to properly disperse loan funds. Maybe their checks bounce due to insufficient funds.
Wow.
Or lender involvement in the improper use of a veteran's entitlement. This could be knowingly letting someone else occupy the property instead of the veteran, or helping facilitate a scheme where the veteran essentially sells their entitlement benefit.
That sounds like fraud.
It borders on it, certainly. Or making a loan when the lender knows the veteran doesn't actually plan to live there and intends to sell it immediately after closing. These actions really undermine the whole purpose of the VA program.
Okay, that makes sense why those get longer suspensions. Let's switch to LAPP authority. What's LAPP?
LAPP stands for the Loan Appraisal Processing Program.
Appraisal processing. Oh.
Right. This is a special authority the VA grants to some lenders, allowing their own qualified staff, called Staff Appraisal Reviewers, or SARs, to determine the property's reasonable value for VA loan purposes instead of waiting for a VA-assigned appraiser in review.
So it speeds things up for the lender?
Considerably. But the VA is very clear. LAPP authority is a privilege, not a right. It's granted at their discretion.
And lenders keep it by playing by the rules.
Exactly. Consistent compliance with all the VA's LAPP requirements and guidelines is essential. It hinges on the VA trusting the lender's valuation process.
And can the VA take this LAPP privilege away too?
Yes. Just like automatic authority, the VA can amend or completely withdraw LAPP authority for proper cause. This applies to both supervised and non-supervised lenders who have automatic authority.
Can it be indefinite, like automatic authority withdrawal?
Yes, the withdrawal can be for a specific period or indefinite.
What kind of things constitute proper cause for losing LAPP?
The VA lists several examples, though it's not exhaustive. Things like technical incompetence, basically, the lender's SAR, showing they don't know enough about appraisal principles or can't apply them correctly.
So bad appraisals.
Or significant errors, yes. Substantive errors in figuring out the property's value or condition, or even just lots of repeated minor errors that suggest carelessness.
Okay.
Also disregarding VA requirements after being told about them. Or if the lender or their SAR no longer meets the basic qualification criteria needed to even be in the LAPP program.
And things like civil judgments.
Yes, civil judgments and convictions can also be grounds for withdrawing LAPP authority.
How does the VA notify a lender about LAPP withdrawal?
Typically, they give at least 30 days written notice. It goes to the SAR, their supervisor, and other officials. The notice explains why they're taking the action and outlines the appeal rights.
30 days usually, but any exceptions?
Yes, a big one. If the VA believes the government's interests are at immediate risk because of the lender's appraisal-related actions.
Like really bad valuations?
Potentially, yes. In that case, the withdrawal can be effective immediately. No 30-day wait. They prioritize protecting the integrity of the valuation.
So, if LAPP is withdrawn, what happens with appraisals for that lender?
The responsibility flips back to the VA. The VA itself will handle determining a reasonable value and issuing the certificate of reasonable value, the CRV, for that lender's loans.
The lender can't do it in-house anymore.
Correct. And if the withdrawal lasts longer than 90 days, the lender has to completely reapply to get back into the LAPP program later.
Is it always a full withdrawal?
Not always. As an alternative, the VA might put the lender on a kind of LAPP probation.
Probation, what does that involve?
During probation, the local VA office might step up oversight. They could review more appraisal reports, maybe have VA staff issue the final value notices instead of the lender's SAR, increase quality control checks, things like that. It's a way to monitor and guide improvement without a full withdrawal.
Can losing LAPP authority lead to other sanctions?
Absolutely. Withdrawing LAPP doesn't stop the VA from also withdrawing automatic authority or even pursuing debarment or suspension based on the same underlying problems.
Okay. And are LAPP withdrawn lenders on the GSA list?
No, same pattern here. If only LAPP authority is withdrawn, the lender doesn't automatically appear on the GSA excluded list unless other sanctions are imposed too.
But the lender is still responsible for making sure the VA handles the values while they're out of LAPP.
Yes, definitely. They need to adjust their process to ensure VA handles the CRVs.
Okay, let's move to the really heavy hitters. Debarment and suspension.
Right. These are the most severe administrative sanctions.
What exactly is debarment?
Debarment generally excludes a program participant from doing business with any federal agency's non-procurement programs.
So not just VA loans, but potentially contracts or grants from other agencies too.
That's usually the case, yes. It's typically government-wide, though there can be rare exceptions for specific transaction types. And it definitely includes being barred from the VA loan guarantee program.
How long does debarment last?
Typically around 3 years, but it can vary based on how serious the offense was. It's meant to protect public programs from irresponsible participants.
And suspension, how is that different?
Suspension has the same practical effect exclusion, but it's temporary. It's usually imposed while an investigation is happening or during legal or debarment proceedings.
Like a temporary hold.
Exactly. It generally doesn't last more than 18 months, and it might be followed by a full debarment if the investigation warrants it.
Do these apply everywhere or just locally?
Nationwide. Debarment and suspension exclusion applies in all locations.
And these folks are definitely on the GSA list.
Yes. All VA debarred loan guarantee program participants are listed on the GSA's list of parties excluded from federal non-procurement programs. And most of those are government-wide exclusions.
So the GSA list is the key place to check for these major exclusions.
Absolutely. It ensures transparency across the government.
Can these apply to individuals or just companies?
Both. Sanctions can target individuals or entire entities. If it's an entity, it could be the whole organization, just one division, or even specific managers or employees within it.
And the VA regulations spell out the reasons for debarment and suspension.
They do. There are specific sections in the Code of Federal Regulations detailing the causes.
What are some examples?
Well, the regs allow it for any other cause of so serious or compelling a nature that it affects the present responsibility of a person. That's broad.
Very broad.
More specifically, things like being convicted of or having a civil judgment for, offenses like fraud, embezzlement, theft, bribery, forgery, basically anything showing a lack of business honesty, seriously violating the terms of a government contract or agreement, knowingly doing business with someone who is already debarred or suspended. That's a big one. Or even failing to pay significant debts owed to the federal government.
So a wide range of serious misconduct.
Definitely.
Now, there's another one called limited denial of participation, or LDP. How does that fit in?
LDP is different. It's a local sanction imposed by a specific VA regional office.
Local, meaning it only applies in that office's area.
Exactly. It restricts a participant's activities, but only within that local VA office's jurisdiction.
What kind of restrictions?
It could be a complete ban on doing any VA loan business in that specific area, or it might just limit certain types of activities.
So more targeted.
Right. It can be used as the only sanction, or sometimes as a quick, immediate measure, while the VA considers something more serious like debarment. For example, an LDP might stop someone from doing VA appraisals in that region, but maybe they could still act as a management broker there.
Like a localized timeout.
Sort of. And like debarment, LDPs can target whole organizations, parts of them, or individuals.
But there are exceptions. You mentioned some groups can't get an LDP.
Correct. Lenders themselves, direct employees of lenders, and manufactured home manufacturers cannot be subjected to an LDP. Other sanctions apply to them.
Why the exception?
It often relates to their regulatory structure or the nature of their business being less geographically confined than, say, a local builder or appraiser. Other sanctions like automatic authority withdrawal or debarment are deemed more appropriate.
Okay. What causes an LDP?
The regulations list things like irregularities in performance within the VA program locally, failing to meet contractual obligations or specifications on a VA-related project.
Like construction issues?
Yes, construction deficiencies that the VA decides are the participant's fault, or just generally failing to follow VA requirements or regulations within that office's area. Often it's tied to performance issues observed locally.
Can one VA office issue an LDP based on what another office did?
Yes, that's an interesting feature. A local VA office can issue an LDP as a reciprocal action if another VA office, or even another federal agency like HUD or USDA, has already sanctioned that participant.
So it can spread?
It can, if other offices choose to issue their own reciprocal LDPs. VA offices can also notify other federal agencies when they issue an LDP. But remember, the jurisdiction of any single LDP is limited to the office that issued it, unless others follow suit.
And if you get hit with a reciprocal LDP, do you get to appeal that second one?
No. The appeal rights are tied only to the original LDP. You appeal the first one, you don't get a separate appeal for each reciprocal action.
How long do LDPs last?
Usually up to 12 months, maximum.
Any exceptions?
One specific one for builders. If they have unresolved construction problems, their LDP can be indefinite until they fix the issues to the VA's satisfaction, or up to 12 months.
Okay, and crucially, are LDP folks on the GSA list?
No, they are not. This is really important. Because LDPs are local, they don't get put on the national GSA list.
So how do you find out about LDPs?
You have to ask the specific local VA office directly. If you're concerned about someone in a particular region, you need to check with that region's VA office.
Okay, good to know. Let's talk about unfair practices.
Right. The VA can use sanctions, debarment, suspension, or LDP against participants who use unfair sales contracts or marketing tactics that harm veteran buyers.
What counts as unfair?
Basically, anything unethical according to reputable industry standards is out, and anything that prejudices the veteran.
Examples?
Trying to enforce contract terms that are blatantly unfair. Using contracts that bind the buyer but let the seller walk away easily, maybe just by refunding the earnest money if they get a better offer.
One-sided contracts.
Exactly. Also, misleading advertising, like saying a house is VA approved or VA guaranteed in a way that makes the veteran think the VA backs the quality of the construction. That's a big no-no.
What's okay to say?
Saying VA financing available or eligible for VA financing is fine. Just don't imply VA guarantees the house itself.
What about builders trying to change deals?
Yeah, tactics like builders delaying things to try and force a veteran to accept changes like cheaper materials, leaving out appliances, or jacking up the price after the contract is signed that's considered unfair.
Handling deposits improperly.
Absolutely. Not handling deposits or down payments correctly, especially for new construction as required by law, or for existing homes if escrow is standard practice locally. And failing to return deposits when the deal falls through and they're supposed to.
Okay. And one more point about FHA inspections.
Yes, for new construction, if the property was built under FHA inspection procedures, the seller has to disclose that in the sales agreement. Failure to do so can be an issue.
Got it. Finally, let's touch on equal housing opportunity laws.
A crucial area. The VA can sanction participants for violating fair housing and fair lending laws.
Which laws specifically?
We're talking the Equal Credit Opportunity Act, ECOA, the Fair Housing Act, parts of the National Housing Act, and specific VA regulations against discrimination.
So, discrimination leads to sanctions.
Definitely. Based on those laws and VA policy, refusing to sell a property to an eligible veteran because of their race, color, religion, sex, handicap, familial status, or national origin can result in debarment, suspension, or an LDP.
Is there certification involved here too?
Yes. Builders and others requesting certain types of VA appraisals have to sign an equal housing certification. They affirm they won't discriminate based on race, color, religion, sex, or national origin.
And veterans too.
Veterans getting a VA loan also sign a certification, promising they won't discriminate if they sell the property in the future. It reinforces the commitment throughout the process.
Okay, we've covered a lot of ground. Sanctions, participants, different types of exclusions.
It's a complex system, but the goal is pretty straightforward.
It is.
To protect veterans using their earned benefits and to maintain the overall integrity and trustworthiness of the VA loan guarantee program.
By holding the participants, the lenders, builders, agents, appraisers accountable.
Exactly. Through this range of sanctions, from monetary penalties and warnings like LDPs or authority withdrawals, all the way up to debarment.
So understanding these rules is really non-negotiable for anyone working in this space, right?
Absolutely essential. It's about compliance, avoiding penalties, but also just contributing to a fair system for veterans.
It really underscores the VA's commitment to making sure the program works as intended.
It does. Which leads to maybe a final thought for you, the listener, to consider.
Go ahead.
Think about the ripple effect of all these regulations. How does this detailed system of accountability within the VA program influence trust and fairness in the broader housing market, especially for veterans?
Good question. Does it set a standard?
Perhaps. And what questions does this raise for you about accountability and consumer protection in other areas? Are there similar safeguards, or should there be? Something to think about.
Definitely something to mull over. Thanks for breaking all that down.
My pleasure. It's important information.